Well, most of us may have been having a blast during this summer. Decentralized finance, or DeFi, communities aren't having so great of a time. With cryptocurrencies collapsing, investors begin to liquidate their crypto in fear of losing even more money than they already have. For DeFi communities, this surely isn't the summer that things turn pretty. And in today's video, we're going to be talking about the recent panic and more. Let's dive in. First up, what's been happening? Right in the middle of June 2022, token holders on Solend, a lending app on the Solana blockchain, had voted to temporarily take control of a major user's account that was facing the threat of huge liquidation, a very extreme move for the DeFi community. Just before this, MakerDAO, an app that supports stablecoin DAI and is run by a popular cryptocurrency community, had suspended the token from being deposited and minted in the DeFi crypto lending platform AAVE. Now, these are some major moves in the crypto community. Following the crypto crash, these only make investments in cryptocurrencies even more rare, considering the risks are only rising. So, why does it affect everyone else? DeFi apps are where users can trade, borrow from, and lend to each other without the hassle of intermediaries like banks. However, these apps are suffering because of their interconnectedness. If troubles occur in one of them, they have cascading effects on the rest as well. Users of these apps often put up tokens as collateral in order to borrow coins from one app that can be deposited to get higher yields in another. When the prices of crypto hit rock bottom, which they had recently, it can trigger the margin calls on collateral, and users that don't address this issue by adding more collateral get liquidated in a process triggered by the software and executed by bots specifically designed for this purpose. Talk about a tricky situation. And now for bots and why they aren't so great. When a user is ready to have their crypto liquidated, these bots, which are run by third-party programmers and traders, compete to liquidate the positions. This is done so that they can earn bonuses for doing so, which is a common practice in the decentralized finance community. Since many bots jockey to liquidate a position, they can lead to clogging a whole blockchain with transactions. In the meanwhile, a dump of a large amount of coins by liquidators can also put pressure on token prices, leading to another cascade of liquidations. By interfering, DeFi communities are trying to avoid this altogether. Paul Vididikit, a partner at Pantera Capital, said, "A lot of DeFi protocols are reducing counterparty exposure during this volatile time. Now, this causes trouble for the DeFi community. So, where does liquidity come into all of this? The communities of DeFi apps have also begun to rally to make sure that their apps aren't damaged by things such as bad debt. For example, if a liquidator can't sell illiquid tokens, or even if the prices of tokens collapse while they are being sold, the apps can end up having to take responsibility for reimbursements." As for Solend, holders had a majority vote in favor of taking over a large user's account as a temporary measure after the app reached out to the user and didn't receive a response, increasing the threat of a massive liquidation. If a plethora of bots began to compete in order to trigger the liquidation, it would result in absolute chaos and put a strain on the Solana network. If the account is taken over, the Solend team could try to liquidate the position in a specific way so that the price of the liquidated token is less affected. This would be done through an over-the-counter sale with a targeted buyer rather than through a DeFi exchange. Next, we have the resulting troubles. The moves that the Solend team plans to make would be highly unconventional and would be breaching the norms of the DeFi community. Not only this, but the crypto community on Twitter would also begin to cause a stir. The move also comes a day after MakerDAO, the app that supports stablecoin DAI, suspended the token from being deposited and minted in crypto lending platform Aave because of Aave's exposure to a troubling derivative of Ether. This derivative is called STETH, and it has become illiquid. And now, a not so favorable suspension. The suspension itself prevents traders from borrowing DAI against STETH. In the meanwhile, users on Aave's governance forum are having a debated discussion on how to reduce the risk from STETH. DeFi risk tracker Gauntlet also mentioned that this may pose further risk to the protocol. But wait, things get worse. If you think that was the worst of it, boy do we have a surprise for you. The pain experienced by DeFi apps was worsened after centralized lenders of crypto, Celsius Network and Babel, froze their deposits. Still, that's not the worst of it. The rumored collapse of fund Three Arrows Capital also drove down crypto prices in double digits in only a week. That's painful for even us to watch. Crypto lender Celsius Network worked with many DeFi apps to earn high returns. According to researcher Novum Insights, approximately 30% of all STETH STETH stuck on Aave is from Celsius. With their freeze of deposits, the DeFi community fell into an intense panic, and this was only worsened since Three Arrows Capital was an investor in Lido, which issued STETH and is debating making a change in its governance. So, how bad is it exactly? Well, we don't want to rain on anyone's parade, but we might have to anyway, since the total amount of crypto in use on apps is about $70.6 billion as tracked by DeFi Llama. This value has only decreased, considering in May of 2022 it was a whopping $205.7 billion. This was just before the Terra blockchain's implosion had set off the year's biggest crypto crisis yet. Next, in other news, Al Jazeera is anti-crypto. On the 26th of June 2022, independent news broadcasting organization Al Jazeera released an article called "Crypto Needs to Be Eradicated." Michael Hiltzik, Pulitzer Prize-winning journalist, author, and writer of this article, mentioned how cryptocurrency had no real legitimate value in the real world and should be erased completely. Hiltzik said that the so-called crypto party should have never existed in the first place because nothing being traded within this party is actually worth anything. This supports the popular idea that cryptocurrency is only fake money. These currencies were promoted with the benefit that they could not be manipulated. However, this also means that they can't be protected, audited, or tracked. Hiltzik said that he was angry at regulators for allowing this to become a mainstream trend, since less informed investors had been bought at high prices and end up dealing with low prices towards the end, even losing their life savings. However, he is also upset with the investors who got sucked into the system, claiming they should have been more careful with their assets. And now, the Central Bank of Morocco plans to introduce Bitcoin and crypto regulation bill. As of June 2022, Morocco is joining the list of countries that aim to formally take control of the crypto sector. They plan to do this by working on a final regulatory framework to guide the market. The country's very own central bank, Bank Al Maghrib (BAM), is designing a crypto regulation outlook in consultation with a global financial institution. According to Bank Al Maghrib's governor, Abdelatif Jouari, the institution has already come in contact with the International Monetary Fund (IMF) and the World Bank to discuss specific benchmarks. Speaking of which, the International Monetary Fund has been a central power in calling countries to regulate the crypto sector, while also issuing warnings on the danger of legalizing assets like Bitcoin. Serving as an example, the institution has also urged El Salvador to drop Bitcoin as a legal tender, claiming that the move threatens the country's economy as a whole. Interestingly, Morocco had banned Bitcoin trading in 2017, but since the asset grew in popularity with the general increase in value, the government could no longer ignore its growing prominence. Still, by 2017, the country reportedly ranked 4th behind Nigeria, South Africa, and Kenya in crypto trading volume all across Africa. Finally, we have Time Magazine's opinion on the result of the crypto crash. Time Magazine argues that the crypto crash may not be the end of the crypto revolution. In fact, it suggests that the cryptocurrency shakeout might benefit the sector by tamping down some of the rampant speculations and help to focus on the beneficial elements of the technology. They make us question whether the government regulators, who were already bearing in on the crypto industry and will surely double their efforts this time around, will choke off innovation. If the design is proper and calculated, regulatory oversight could prove to be beneficial, since it would confer greater stability and legitimacy. The revolution of cryptocurrency had promised to democratize finance by reducing the power of large banks and other typical financial institutions, while also broadening the access to basic financial products and services. The purpose of this was to allow less wealthy households to benefit from them, but many of these benefits unfortunately remain unrealized. Still, there may be a shrivel of hope remaining for cryptocurrency in the future. That's a wrap for this video. What do you think of cryptocurrency? Let us know in the comments below. Make sure to give this video a thumbs up and subscribe to our channel for more videos like this. See you in the next one.